Welcome to Talk Tickers, where we break down the most recent earnings calls. Today, we're digging into Tronox's Q2 2025 earnings report, and let's just say it was a bloodbath. So let's just kick things off with the market's reaction. I mean, wow, a nearly 38% drop in a single day. That number right there, it tells you pretty much the entire story of how Wall Street felt about these results. All right, so here's how we're going to break this down. First, we'll look at the headline numbers that just totally missed the mark. Then we'll get into what management had to say about it all, their diagnosis, if you will. After that, we'll walk through the defensive playbook they're rolling out. We'll also cover the market's reaction and what catalysts to watch for. And finally, we'll wrap up with our take on what the next call might look like. Okay, let's dive right in. Section 1, the headline miss. These are the numbers that really sent the stock into a tailspin. So yeah, here's the damage report. A miss on both revenue and earnings. And we're not talking about a small miss here. The consensus was for a tiny loss of 4 cents per share, and they came in at a loss of 28 cents. Ouch. Revenue also came in light, missing by about $60 million. And just to put that earnings miss into perspective, look at this. They weren't just a little bit off. The actual loss was 7 times worse than what analysts were expecting. That's not just a miss. That's the kind of number that makes investors completely reevaluate everything they thought they knew about the company. And that pain flowed right down to their core profitability. Adjusted EBITDA, it just collapsed, down 42% compared to last year, landing at only $93 million. You can just feel the margin pressure in that number. All right, so you see those numbers and you have to ask, what on earth happened? Well, let's get into management's diagnosis. And to sum it up, they basically said it was a perfect storm, with everything going wrong at the exact same time. So here's a quote from the CEO, John Romano. In plain English, nobody was buying. The busy season for paint sales, which is super important for them, was a total dud. And on top of that, competition got really, really fierce. So let's unpack those headwinds a bit more. You had weaker demand from construction and coatings, which makes sense. Then, this intense competitive pressure, especially from China. They're also waiting on some anti-dumping duties in Brazil that got delayed. And of course, you have high interest rates making everyone hesitant to spend. The end result of all this? Their volumes for TiO2, that's titanium dioxide, the key ingredient in stuff like white paint, were down a whopping 11% year over year. Okay, so the situation looks pretty bleak. How did management react? Well, they didn't just sit there. They immediately shifted into defense mode. Right now, it's all about one thing, protecting the balance sheet. Forget growth for a second. The new game plan is all about cash preservation and cost control. It's about weathering the storm. And they're coming at this from 4 different angles. First, they're hitting the gas on their cost-saving plans. Second, they're idling a big plant in Europe to better match supply with this weak demand. Third, they're taking a knife to their full-year guidance, basically hitting the reset button on expectations. And fourth, and this one really stings for some investors, they're slashing the dividend by 60%, all in the name of holding on to cash. So management is doing all this stuff, right? Pulling levers, cutting costs. It sounds proactive. But the market was not impressed. Investors basically ignored all that and focused on a completely different and much scarier set of problems. And this slide really gets to the heart of the disconnect. On one hand, you have management trying to talk up the positives. Hey, look at our sales in India. Our cost program is working. Our debt isn't due for a while. But on the other hand, you have the market screaming, we don't care. Your demand just fell off a cliff, your prices are getting crushed, and your leverage is at a sky-high 6.1 times. It's like they were speaking 2 different languages. So what are we watching for now? Well, there are a few key dates on the calendar. In early Q4, we'll get that final anti-dumping ruling in Brazil, which could help. Management is also promising this step change in their costs to kick in around the same time. But really, the big one, the thing everyone is really waiting for, is any sign of life in the global construction and coatings markets. That's the make-or-break catalyst for the first half of next year. All right, let's put it all together. Section 5, the next call, and our take on what happens from here. It really all boils down to this one question, doesn't it? Can their internal cost-cutting and focus on little pockets of growth actually be enough to fight back against this massive, severe cyclical downturn? I mean, they're doing everything they can inside the company, but the macro headwinds are just a hurricane. Is their self-help plan a big enough boat? So, for our Q3 forecast, we're not expecting any miracles. We see another tough quarter ahead. We're penciling in another loss for adjusted EPS, with revenue and EBITDA basically treading water. The cost savings should help, but probably not enough to overcome the ongoing weakness in volume and pricing. We might see things start to turn in Q4, but that is a big question mark right now. So where does that leave us? Our rating on Tronox is underperform. There's just too much risk to their guidance, even after they've lowered it. And those macro headwinds are just relentless. Until we see a real, tangible sign that demand is bottoming out and turning around, it feels like the path of least resistance for the stock is, unfortunately, still down. But hey, let's have a little fun with our outrageous but plausible trade idea. Now, this is for folks with a high tolerance for risk, okay? The thesis is simple. The market loves to overdo it. It punishes these cyclical stocks way too hard on the way down. So, if, and it's a big if, we get any hint of macro stabilization, this thing could rip higher in a massive relief rally. So how would you play that? You could look at some long-dated, out-of-the-money call options. It gives you that leveraged upside if you're right, but your risk is capped at what you paid for the options. The major risk? The downturn lasts way longer than you think, and those options just, poof, expire worthless. So there you have it. Tronox is a textbook cyclical stock, and right now it's stuck in a really tough part of the cycle. The entire bull case from here rests on being able to perfectly time that recovery. And as always, this is not financial advice.